Hey, good morning, everybody. I want to welcome you to today's presentation, Q2 earnings sneak preview. Got John Hopkins here, Tom Bowley gonna jump in just a minute. Want to welcome everybody and thank you for taking the time to join us this morning. Some of you are new to Earnings Beats, first time with us. Want to welcome you. Certainly want to welcome our seasoned veterans. Some of you have been with us for many years. Really appreciate it. All you do for the company and how you've helped us with our success. Today's event will be recorded. All of our webinars are recorded. If you are a member, you can actually visit our very extensive archive, learning archive. A lot of great information on the market, technical analysis, options, anything really to do with equities. Today, we're going to dive into a sneak preview of earnings. It's hard to believe that starting next week, we're right back into earnings. These quarters go by so fast. And it'll start with the banks. And then from that point forward, thousands of companies over the next 3-4 weeks reporting their earnings. And given our name, earningsbeats.com, you can imagine this is the time we shine. An awful lot of information coming to us and presented to you for trading opportunities. Today's event is to discuss a full Q2 earnings session that'll be coming up next week when we get into companies that have reported already, companies that are looking to report, what things to look for, which companies might be poised for strong results, everything you need to know as we move into this heavy-duty earnings season coming up. If you're just joining us today for the first time, encourage you to visit our website, earningsbeats.com. You can sign up for a free 30-day trial, no cost for 30 days. And it's a great time to do it with all the events we have coming up. Next week, we've got the Max Payne webinar that's coming up. This has to do with the options and those companies that could be poised for a big move one way or another next week and into earnings, options expiration Friday. We've got our ETF draft coming up soon, where Tom's going to unveil what he sees as the best ETFs for those people who are interested in maybe not individual stocks, but perhaps spreading it out a little bit. And then, of course, week after next, we'll get into the actual Q2 earnings. So there's so much going on. It would be a great time really to consider the no-cost trial. Okay, with that said, I'm going to see if Mr. Bowley's in the house. Good morning, Tom.
Good morning, John. How you doing?
I'm doing great. It's a great day here in Charleston, South Carolina, nice and sunny, a little bit warm, but no complaints whatsoever. How about you?
Yeah, not bad. Of course, we had the remnants. I guess you probably got more of the remnants of the tropical storm that went through from Florida.
Yeah.
I know it was a little rougher, I think, toward you on the coast. For those of you out there who don't know, I'm kind of in the Charlotte area, just a little bit south of Charlotte into South Carolina, but I'm kind of on the west side of the state. John's on the coast, and I know we had that tropical storm going up through there, so hope everybody's okay from that.
Yeah, actually, unbelievably, not much, at all. So I'm keeping my fingers crossed, knock on wood. Things stay pretty calm this year. That'd be fine with me. Anyways, I'm going to go ahead and step aside because I know you've got a lot to cover. Again, reminding everybody the session's recorded. You'll get a copy as soon as we get it put together. And I hope you have a great session.
All right, sounds good. Yeah, we don't have a whole lot for today, so I don't think it'll be a very long webinar. Hopefully in the next 30, 45 minutes or so, we can get through a number of companies. I really wanted to go through and talk about, looking at charts and then considering what kind of story they might be telling us as we go into earnings season and each of their individual earnings reports. I'm a firm believer that, you watch what's going on in the chart, and the chart will tell you a lot of what Wall Street thinks of that company. And so I think by taking a look at, the charts before earnings, I think they give you a pretty good sense of what to expect. I mean, a company that's been underperforming its peers and underperforming the S&P 500, you have to realize that Wall Street, the financial firms, the big Wall Street firms, they go out, they meet with management up until the end of the quarter. So right now they're in their quiet period. So they're not out meeting with management now. It's forbidden. But leading up to June 30th, they can talk to management. They can, see how things are progressing at the company. They can take a look at, how they're doing relative to maybe some of their some of their competition. And so I think looking at the charts tells you a story. And that's really what, when we get into these earnings webinars, that's really what we're doing is we're looking at the charts and trying to make some pretty educated guesses. I feel pretty confident that when a company is outperforming its peers and outperforming the S&P 500, that it's likely to report really good numbers. And that doesn't always mean that we'll see a stock gap up with earnings, because sometimes you have a buy on rumor, sell on news kind of thing, where a stock will go up into its earnings and then reports great numbers, and then everybody sits back and wonders why the stock's going down. So there's a little bit of a disconnect there. And as long as you understand that going in, I think you're in a better position to understand maybe what's happening with that stock and with the market. So the whole idea with this is just to take a look at a number of charts, and we're going to rifle through a bunch of charts today, and just look at relative strength, look at the absolute charts, look at the groups, the industry groups that they're in, and make some educated guesses as to what we can expect with earnings. So that's really the whole idea with this webinar. As John mentioned, we have a ton of events coming up. If you're not a member of Earnings Beats, we do have a 30-day no cost trial. So we'd love to have you come in, just check us out, experience some of the webinars and so forth. Usually the first month of a quarter, we have a ton of webinars because there's just so much going on with respect to earnings and so forth. But let me go ahead and take you over to Earnings Beats real quick, and then we'll get into the charts. So we've got a webinar special. We always do these specials, and so I just want to make sure everyone's aware. But if you're a current member, or maybe you're not a member at all of our community, if you do check us out through Wednesday of next week, so that gives you 4 full days to kind of explore our site, check out our service. But between now and next Wednesday, you can sign up for an annual deal, and you do get an extra bonus month. So you get 1 extra month. It's $147 value. If you do, if you were to pay monthly for 13 months, it would cost you $1,900. You can do our annual special, and it is only $997 for the year. So it's almost 50% off. So definitely worth taking a look at. There's a lot of things that we do. I like to refer to our service really as a research and education platform. A number of chart lists that you can download right into your account. If you're a Stock Charts member, if you're not a Stock Charts member, you can take the Excel list and you can download that and literally put that right into whatever platform you use. So you can still benefit from a lot of the work that we do at Earnings Beats. But check that out. I just want to make sure you're aware of that. And that goes on through Wednesday, July 14th. All right, let's talk a little bit about earnings. Simulations Plus is one company that'll be reporting on Monday. I'm going to get into that in this particular chart in just a minute. I do want to pull up, before we get into this, my Chart Watchers article. If you had a chance to take a look at that, great. If not, you might want to look at it later. One of the things that we look at, one of the indicators that really helped us in 2020 was the strong AD or weak AD. It's accumulation distribution lines. And all it does really is just take a look at how a company trades from the opening bell to the closing bell. So it doesn't, if it gaps down or it gaps up, it doesn't care about that. What the AD line focuses on is once you've opened, how do you trade throughout the day? And the volume matters because the AD line is simply an accumulation of the volume, but it's not total volume. It's a volume based on where you close that day. So in other words, if you open at $10 and that's your low of the day and you go up to $11, and then come back down and close at 10.50 right in the middle of that trading range, there's no impact on the AD line because you literally closed right in the middle of your trading range. But if you were to close at $11 at the high end, then all of that volume would be added to your AD line. So it's just it's a way to look at a different way, I guess, to look at your accumulation or distribution of a particular stock. So a lot of what we look at today, I'm going to focus on the AD line. That's really what I focused on in my article this weekend. So when we go through and look at these charts, like Wells Fargo, I had pointed out, if you go down and look at the AD line, even though the stock has been moving down quite a bit over the last 6 weeks or so, 8 weeks, the AD line has stayed very strong and just recently almost went to a new high, even though price did not make a new high. So I think that this is a pretty strong AD line. And when you look at the banks, I think this is one of the stronger AD lines. So Wells Fargo, to me, it just kind of, I just get this feel like institutions are accumulating the stock. And the AD line is just one part of that. I mean, if you see the breakouts, you see the heavy volume coming in. These are all different signs that also suggest that maybe a stock's under accumulation. But the AD line confirms it to me. And I've had questions before, would you buy a stock simply based on the AD line? And my answer is no. It's a confirming indicator. It's an indicator that I like to follow, but it's a secondary indicator. There's nothing more important than price. So if a stock is downtrending and I see the AD line going up, I mean, it's a head scratcher. It makes me wonder, okay, maybe the stock's being accumulated even though it's been going down. But if a stock's been going down for 12 months, 18 months, the fact that the AD line's going up doesn't change the fact that the stock is still under pressure to the downside. So just, you have to know its place. The AD line is not something that I would use as a primary indicator to either buy or sell a stock. All right, so here's Wells Fargo, but further down in the article, I wrote about a few companies. And these were companies that I found pretty interesting in terms of their AD lines. So the first one I want to talk about was just IMAX. So IMAX, you can see we had gapped up from a February high or close. I think this was $18.64. And you can see we gapped up, moved higher, volume picked up throughout this move. And since then, the last 3 lows have come back into this gap support range. And I think one of the things, at least to me, that's very interesting is that even though it continues to move lower, the AD line has been rising during this period. Now, I don't know if this is going to be something that's significant, but it is something to at least recognize. I think it's part of the technical picture here with IMAX that, yes, it's been moving lower, but that AD line moving higher tells me that perhaps we're seeing some accumulation in the stock. And over time, if it's true, then we should see prices moving higher. So I actually like this chart just because it's holding in this gap support area. So notice I'm paying more attention to the technicals in terms of buying or selling the stock, but I'm aware of what's going on with the AD line. I think that's really important. All right, so IMAX I think looks really looks like a pretty good stock. Now, if you notice the rest of these panels down here, you'll see recreational services. This is the industry group trying to hold support around 98. So far, it's doing it. You can see IMAX relative to recreational services, not really doing a whole lot. So you would think if a stock's heavily under accumulation, it would at least be outperforming its peers, and it's not. So the AD line isn't the total story. That's just one piece of the story. And so as I go through and look at some of the other areas, I definitely want to be cautious. So if I were to get into the stock, if it loses major gap support like this, I'd have my stop in, make sure I don't, lose too much to the downside if I'm wrong about the stock. But overall, I do like that AD line moving up. Down here below in these panels, you can see IMAX relative to the S&P 500 just moved to a 52-week low. So it's not one of the best stocks out there. And I'm just going through this because, again, all of these different signals, all of these different lines tell us a different part of the story. Recreational services down near a 52-week low relative to the S&P 500. So these are all important signals. Now I'm going to go into the next one, which is Ferrari or race. And when you look at this chart, the price chart, again, you're not really seeing anything that stands out. I mean, I see an uptrend, a high set back at the end of 2020, big downtrend, and then just a lot of sideways consolidation. So just looking at the price chart, just looking at this, I wouldn't be interested in the stock. But I noticed the AD line is breaking out to a new high. That's at least worth noting. Race reports its earnings, I think, on August 2nd. So we've got maybe about 3 weeks or so before they come out with their earnings. Is this a precursor? Are we being told that the stock's being accumulated prior to this? Well, that's what the AD line's telling me. But again, when I go down and I look at relative strength, I've got this double top race relative to the auto index. Haven't been able to break out. So got a little bit of a problem there. And then you can see autos has been struggling. This whole group has been struggling relative to the S&P 500. And then finally, Yeti, YETI. Now this one to me is the best of the three. And the reason I say that, the AD line is strong, but the reason I say that's all the other indicators are lining up better on this stock than the other two. So the story that's being told to me here is a much more bullish story than with the other two stocks. So the first thing you see, or I see when I look at Yeti, is we're in a nice uptrend. It's confirmed. We broke out above this double top here, right around the 79 level, January and February highs. We did that in April. You can see the breakout. You can see the volume picking up. When we went back down, we hit this level and buyers came back in. So that is kind of the gist of an uptrend. You've got higher highs, higher lows, and that's kind of really what makes an uptrend. Now, if we go down a little bit further here, take a look at the AD line. So in addition to a trending stock that's trending higher, you also have the AD line, which is moving up. So you're getting confirmation. So again, I wouldn't buy a stock simply because its AD line looks strong. But to me, this is confirmation. It's adding to this bullish price picture. When we look at these other panels, recreational products moving higher. And again, if we go and look at some of these others, you've got autos, which kind of consolidating. And then you've got the recreational services, which over the last 6 weeks has been downtrending. So I just think overall, you've got a better industry group with Yeti. It's clearly got defined higher highs, higher lows, and then relative to its peers. In the month of in the month of June, it broke out on a relative basis, took out the highs from earlier in the year. That would have been back in December here. So we've got a new relative high. So it's a strong stock within a good, solid industry group, which over the last, 8-9 months has been outperforming the S&P 500. So this is just the type of stock that I would feel really good about going into earnings. I think Yeti's going to have a strong report. And I think, actually, I didn't put it on this chart. Let me give you that earnings date. So Yeti will be reporting on August 12th, so about 1 month from now. But I think based on everything you see on this chart, I would expect a very, very strong report. Now, that doesn't mean we'll see what Yeti does heading into earnings. If it continues moving higher, it could be a buy on rumor, sell on news kind of event. So again, just because the stock looks good, just because the stock comes out, reports great earnings, doesn't necessarily mean you're going to get a bullish reaction. But when I see a stock that's performing well, reports great numbers, and then moves lower, I actually have quite a bit of confidence of looking for key support levels and potentially accumulating a stock like that. One thing I wanted to show you, if you're not familiar with this, it's stock charts. If you go to this drop-down menu here to symbol summary, and we type in Yeti, it'll give you a lot of really good information. First of all, if you're using this, it'll give you pre-market and after market action. So if you're looking at a stock 9 a.m. and you want to know what it's doing pre-market, come to this drop down, hit symbol summary, and then type in your symbol, and you can find out what's going on in the pre-market. But here is the next earnings date. So that's where you can see any of your stocks when they're going to be reporting next. You can come to this page. The other thing is, and I like to look here, is it gives me any chart list that I have. This is going to be in my account. So if you go here, it's going to be whatever chart list that you have in your account, but it'll tell you if Yeti is in any of your chart lists. And so when I look at Yeti, I see, okay, it's in my strong earnings, it's in raised guidance, and it's in our model portfolio, and then some of the other portfolios that I've used in the past. So it just gives you a little sense of, okay, if you have a watch list, you'll know whether or not Yeti is on that list. All right. So anyway, those were the three that I reported and talked about in the chart watchers, but I'm going to go through pretty quickly a number of stocks that will be reporting over the course of the next week or so. So let's start off on Monday. And these, I'm just going to go through companies that have reasonable size market caps. I'm not going to go into the micro caps or the, really small companies. This is probably about as small as it's going to get, but I'm going to look at Simulations Plus, SLP. So they report on Monday. And if you're looking at the stock, it was $90 back in February. Now it's $53. So you probably don't need to do a whole lot of relative strength analysis to realize this has not been a very good performing stock. But if you're not familiar with the company and you just want to see, okay, what group is it in? You can pull this up. SLP is part of the software group. And look at the relative strength line here of SLP relative to software. It's moved to a 52-week low. So that right there is telling me that we've got some issues. Wall Street obviously is not impressed with what's going on in this company. Software on an absolute basis has been going up for the last 6 weeks, straight up almost, from 4,400 and change to above 5,200. And yet during this entire period, SLP has done nothing. So even with its overall group very strong, its peer group moving higher, SLP's gone nowhere. So that just tells me if money is rotating away from this stock within its peer group, we shouldn't be expecting much when earnings come out. Now, you might say, well, that means the bar is set really low, so maybe we should jump in. I don't view it that way at all. I like relative strength. I think in time, relative strength is going to play in your favor on the long side, and you want to stay away from these companies that are showing poor relative strength. So when I look at the chart, the story I'm getting, and that's when I look at charts, that's what I'm looking for is the story. When I look at this company and I see the last 4 or 5 months here, the story I'm getting is Wall Street is not impressed at all with what's going on here. So that doesn't mean it won't go up with earnings. Sometimes you have a dead cat bounce, but unless they come out with some kind of earth-shattering news, this is a company that I would continue to avoid. All right. Let's move on. So that is really the only company on Tuesday, or excuse me, on Monday that is of any size. I mean, it's a $1 billion company, still very small compared to some of these others I'm going to go over. All right. I'm going to go through and point out on an RRG chart some of these companies that'll be reporting this week. So if you go to your homepage at Stock Charts and under Member Tools, just scroll down until you get to RRG charts, and that is under your charting tools area. So if I click on that, the default benchmark is the S&P 500, and I kind of want to see what stocks are doing relative to the S&P 500. So one thing you can do is simply type in the charts that will be, or the companies that will be reporting. So on Tuesday, for instance, JP Morgan reports, Pepsi reports, Goldman Sachs, First Republic, that's a smaller, well, it's still a regional bank, but it's in San Francisco, Fastenal, Conagra, and ANGO. All right, so this is about a $1 billion company, pretty small company. So these are the companies. I'm going to just put in the daily and just look at these companies relative to the S&P. So without looking at anything else, I can kind of get my own little sneak preview of the companies that are reporting on Tuesday. Now, when you look at these companies relative to the S&P 500, I see a lot of companies that are starting to strengthen. They're in the improving quadrant, most of these, but they haven't yet moved into the leading. I still view this positively. I think if Julius de Kempenaar was here with us, he's the creator and founder of the RRG. I think he would tell you that, these are stocks to watch, stocks that he's interested in. He likes the long tails moving in this direction, north to northeasterly. This one is moving the opposite. It's been a very strong relative strength and relative performer, but it's obviously been weakening over the last several days. And then the tail length is something else you can adjust here. So if you want to see where this, where a stock has been, you can kind of change the length of the tail. And then if you just want to follow one stock, you can click on that stock. So if we just click on JP Morgan, you can see that particular stock highlighted on the RRG, and then we'll max out. And then of course you can go back a year and you can just see how JP Morgan has been performing relative to the S&P 500. So it tends to be mostly on the right-hand side of the chart. And actually, this is a pretty interesting move it made at the end of 2020. So you see how it was in the leading, came into the weakening, and then curls back up. That is very typical. A stock, when it's doing well, moves into the leading quadrant. And then sometimes when it's consolidating, just goes through a period of consolidation. Market keeps going higher, stock consolidates. It tends to move into this weakening area and then reverses back up into leading. And then it finally takes a move there into the lagging and then turns back up. So right now it's starting to show good momentum. So where you are in terms of looking at this horizontal axis, this is giving you an idea of momentum. If you're above the horizontal axis, your momentum is stronger than the S&P. If it's below, then it's not as strong. I'm actually more of a fan of the relative strength, which is the vertical axis. Anything to the left tells you that you're underperforming. Anything to the right tells you you're outperforming. So we're starting to strengthen on JP Morgan, but we got some work to do. That's what the RRG tells me. Anyway, that gives you a sense, though, of how you can see how companies are doing heading into their earnings report. just another signal. You know, it's not, I'm going to buy the stock or I'm going to sell the stock based on what I see on an RRG. But this tells you, okay, ANGO has been a pretty good performer. Maybe I need to look at that chart. And so then I come over and I pull up ANGO, and it's been a nice uptrend. We just had a false breakout on Friday. So in the short term, maybe it pulls back, but this is a company that I would expect a strong report from. Here's the AD line. AD line's broken out, so it's confirming the price action, which I think is good. And if we go down here and we pull up the relative chart, you can see it's in the medical supplies area. Medical supplies just broke out. Good news. This is a stock that's performing well relative to its medical supply peers. And then medical supplies relative to the S&P 500, really just kind of going along for the ride the last 3 or 4 months, mostly sideways, off of its relative high from February. So it's not the best group, but it's okay. And you've got a leader. So I would expect pretty good numbers here from ANGO when they report. All right, let's move on to Wednesday. So I'm going to pull Wednesdays up in an RRG. We'll do this again. All right, so on Wednesday, and this is when the banks really start kicking in here. So we got Bank of America, Wells Fargo, Citigroup, BlackRock, Infosys, PNC Financial, and Delta Airlines. So those are the major companies that I'll be reporting on Wednesday. And once again, we have one company that's over here on the right side. We'll look at that chart in just a minute. Look at Citigroup. I mean, over the last 3 weeks, roughly, look at the length of this tail. It was badly underperforming the S&P 500. It's starting to move a little bit more toward the right side. This, remember, the vertical is relative strength. So we're seeing the momentum pick up, but we're just barely starting to see relative strength turn. So I'm going to look at 2 charts here. I want to look at Citigroup, and then I want to look at INFY. And also keep in mind, many of these stocks are over here on the left side. Why? Because they're banks, and treasury yields have been going down. So many of the banks have been underperforming the S&P because the group's been underperforming. So if we actually change this, what I'm going to do is I'm going to take out anything that's a non-bank. And I'm going to change the benchmark to the bank index. Now, this gives you a different story because they were all on the left side of the chart because banks have been weak. If banks are weak, you know, it's going to provide headwinds for a stock. If you're in a group that's not performing well, your chances are you're not going to perform well. But this is what's telling us which stocks are stronger within the bank area. So these 4 banks, I think you can, again, here's a story. I'm seeing a story from this chart. Hopefully everybody is seeing a story. Citigroup, look at it relative to the bank index. Look at PNC. 2 stocks from the same industry group going in opposite directions. So let's take a quick look at these charts on a sharp chart. So first, let's look at Citigroup. Now, when I look at Citigroup, I see a stock that's broken down below its moving averages. Volume picked up. Kind of had a little bit of a dead cat bounce. Couldn't even get to the 20-day, and then rolled over and put in a new low. So just in the near term, this is not the type of chart that I would be interested in. But let's look at PNC. Let's see what, you know, is it looking different? I think it is. To me, you can see the tops back here in March and April around 180. We went down, we went just below 180 and we rebounded. Again, let's go back to Citigroup. Do you see that kind of configuration? You see these tops? This top was $75. We're trading at 68 now, way below that high. So that's what it looks like on a sharp chart. And what I showed you a few minutes ago on the RRG is how you can visualize it relative to its peers on an RRG chart. So let's go back to PNC. And the way this looks on a relative chart, look at PNC relative to the bank index, up near a 52-week relative high. So we know banks have struggled. Here's the pullback in the bank index. But PNC is performing really well relative to its bank peers. If we pull up Wells Fargo, see the breakout here at about, what was that, $41? We didn't even get down to $41. So I think on a relative basis, before we even look below, I think we've got a pretty strong bank stock right here. And we go down, look at Wells Fargo setting a 52-week relative high versus the banks. So you tell me, we're going into earnings. Let's pull up Citigroup one more time. I mean, when you look at Citigroup relative to banks, it's near a 52-week low. What story is being told to you? Citigroup, PNC, Wells Fargo. Which company, which of these banks do you think Wall Street has the most confidence in heading into earnings? Hopefully, you'll say Wells Fargo, because I think that's one of the wonderful things about relative strength. Relative strength doesn't lie. There's no sugarcoating. When you look at a stock relative to its peers, there's no mistaking leaders from laggards. So again, now, does this mean Citigroup's going to go down with its earnings? No. And most companies, in my opinion, are going to beat. But maybe Citigroup's got some dirty laundry or something. I don't know why Citigroup is underperforming the way it is, but I know it's underperforming. I don't need anyone to tell me. I don't need to go to CNBC to find out that Citigroup is a laggard in the banking group. I can look at a chart. Chart tells me everything. So as we go into these reports next week, just keep this in mind, and let's see how these banks report. All right, let's do Thursday. So Thursday, let's go back to the dashboard. And again, just scroll down till you get to RRG. And then type in your symbols. So we've got Taiwan Semiconductor, United Health Group, Morgan Stanley, USB, another bank, Truist, another bank, TFC, the Progressive Group, Bank of New York, Cintas, whoops. And let's see if there's anything else. Alcoa, a couple others. WNS Holdings, Home Bank Shares. That's probably about it. All right. Excuse me. All right. So these are the companies that are going to be reporting on Thursday. And let me go ahead and select these. I'm going to put these on the daily chart. So currently, and it's just the tail length is 5 days. So it's just telling you what these companies are doing relative to the S&P 500. And you can see CTAS, and this was a company I think I wrote about in our free Earnings Beats Digest a couple weeks ago, or maybe a week ago. I don't know. It had broken out above some consolidation. So we'll pull that chart up in just a minute. But PGR is was in the improving, just working its way into leading. So tell you what, let me go over here. And we'll just do a different tab. So I'm going to grab PGR and CTAS. Let's look at those two charts. All right, so PGR, you can see false breakout here. So it's definitely been showing some nice strength. AD line, by the way, just set a 52-week high. Price didn't, but the AD line did. I kind of like that. But it looks to me like an uptrend and maybe a left shoulder, neckline, head, right side of a neckline with a false breakout. I would suspect in the near term, maybe we'll see a little pullback, maybe to the 20-day, 97.5. But if we come back up and break above 101 on a closing basis, this would be a really bullish looking chart. And knowing that the AD line is setting a new high, that just adds to the bullish picture. So going into earnings, maybe we pull back and maybe earnings are the catalyst that gets us this breakout of this inverse head and shoulder. This is a bullish continuation pattern, by the way. All right. The other one was CTAS. Let's pull that chart up. All right, so here you can see months of sideways consolidation. I love charts that do this. I like months. I like a basing and then a launch. Look at CTAS. Look at the volume coming in as it makes this breakout. It struggled between 360 and 370 on many, many different occasions over the last 10 months. Finally, we got the breakout. We got volume coming in on that move, and now we've got new highs. So CTAS, I think, looks really strong here. 20-day test to me would be an opportunity for entry, and maybe we get that with earnings. Again, companies that report strong earnings don't always get a positive reaction. Most people who don't follow technical analysis, I would say that is probably the one thing that I get the most questions about from folks who are kind of new to technical analysis. They see a company report great earnings, and the company goes down with those results and they don't understand why. How can that happen? How can a company come out with great numbers and go down? Well, many times it's because a lot of the demand, a lot of the buying has taken place before those numbers come out. Wall Street's already getting in, and that's what I see on this chart. I see CTAS being accumulated. Now, if you look down, AD line had been going down, down, down. But here over this last 5 weeks on this move, you can see the AD line turning up. It's now at about a 4-month high. So I'm beginning to see accumulation. I see it in the price action. I see it on the AD line. I think CTAS is going to have an explosive report. I think the report's going to be really good. Now, whether or not the stock reacts positively is another story. But what I like to see are bullish charts, great numbers, and then a sell on the news, because that's an opportunity to get in to a really strong company. So these companies, when you're looking at them and they're showing great relative strength, when they report good numbers and they get sold off, watch key support areas. I'd be looking at price support here at about 366. I can give you the exact number. That high was 367.07. 367.07 is a key support level, price support on any pullback. You've also got the 20-day EMA at 375. So the current price of the stock's 388. So getting in at 388 ahead of earnings, in my opinion, presents some risk, whether they're reporting earnings or not. When you're buying a stock in an uptrend and it's got room to the downside to hit key support levels, you're taking more risk than if you wait and try to get the stock on these support levels. Now, not every stock will come down. So you could say, well, I'm going to wait, and when CTAS reports its earnings and comes down to its 20-day, I'm going to buy. Problem is, they may come out with earnings be at 450. We don't know. All I know is that if you're buying above these levels, you're just taking more risk. You know, whether you buy at 388 or you buy at 375, that's not going to change the earnings that come out next week. It's just a matter of how much risk you want to take. And that's really what trading or even investing is all about. You got to be willing to take risk. And to me, technical analysis is all about managing risk. Some people don't like technical analysis. They say it doesn't work. And I'll be the first to admit it doesn't work sometimes. I don't use technical analysis looking for a guarantee. I use technical analysis to help me manage my risk. Big difference. All right. So let's see, maybe look at one more of these stocks, and then we'll get ready to wrap up. So here's MS. So again, I can go down and I click on Morgan Stanley, and I can see exactly what's going on. I can then drag this back. I can see over the last few months. Whoops, let's do a max chart. There we go. So I can look back over the last few months. I can see where Morgan Stanley has been, how it's been performing relative to the S&P 500. And if you want to change that to its peers, you can put in investment services, the DJUSSB. Now, of course, all of these stocks are being looked at relative to that, which is not very meaningful. But I want to see how it's been performing relative to its peers. And it's kind of doing okay. Just kind of hovering around the middle. Let's get rid of all of this. But I mean, you could then even just say, okay, what about Morgan Stanley versus Goldman Sachs? It's another thing you can do with the RRG, which I think is pretty cool. So I'm thinking about moving into this space. Which one of these two companies do I want? Well, I mean, Goldman Sachs, I mean, they're both kind of moving together, which is what you would expect. Morgan Stanley's got more momentum right now and maybe even a little bit better relative strength. You flip it to a weekly, sometimes that'll change the picture. All right, let's max this out. And so relative to its peers, both of these stocks have been pretty good over the long term. But Morgan Stanley, from a longer term perspective, is already strengthening. Goldman Sachs is not. So what do these two charts look like? We see what it looks like on the RRG. Let's take a look at the price action. So I would look at this. The first thing I would do, if I would say, okay, it's been doing pretty good relative to its support. So there's your price high, came down, little cup, handle, breakout. When we've pulled back right about to that area of support at about 84. Recent high 94. So Morgan Stanley, when I look at the chart, forgetting about everything else, just looking at the price action, I see an uptrending stock, sideways consolidating. Nothing wrong here. Now, as I go down, you can see the AD line is positive. I mean, we have a new high. I'm going to also pull up the relative strength. So there's your AD line. And this is what it looks like on a relative strength basis. Now, again, when we were looking at that RRG, remember Morgan Stanley and Goldman Sachs were on the right side of the chart, that weekly chart. So the long-term picture to me is two companies that have performed really well on a relative basis. And here's the price relative panel that confirms that. Now let's pull up Goldman Sachs. Let's see. You know, what you're doing is you're trying to put together all the possible evidence that you have. If you're literally trying to decide, do I want to buy Morgan Stanley? Do I want to buy Goldman Sachs? It's a jigsaw puzzle, and you're trying to put the pieces together. I like both these charts, and I think they're somewhat similar. So if I annotate here, there's your breakout right here. We went down, tested that area. So you got your recent high up at about, I don't know, 385, 390. You got your recent low down around 350, and we're sideways consolidating. AD line's been pretty strong, not quite breaking out, so maybe give the edge to Morgan Stanley there. So as I look at these two charts, I like them both. I think they're both leaders in their space. But if I had to pick one, probably would give a slight edge maybe to Morgan Stanley. But I like both of them. And because they've both been strong, I mean, I guess there's an argument saying, hey, well, Goldman Sachs has been a little weaker in the near term. Maybe that presents a little bit better opportunity. And I wouldn't really argue with that. I think it's just how you interpret the story and what you're comfortable with, because everybody's different. But generally speaking, that is a game changer to me. Relative strength is a game changer. You know, Goldman Sachs and Morgan Stanley, maybe it's splitting hairs. Wells Fargo or PNC, which were really strong, versus Citigroup, that's not splitting hairs. That is one bank stock or two bank stocks really strong versus one not so strong. All right. That's pretty much what I wanted to cover for today. Now, we are doing another one of these Q2 earnings, our regular one. Of course, I'm just looking ahead right now to what's kicking off earnings season next week. When we do the Q2 earnings, I'm going to be looking at literally thousands of companies' earnings or charts, trying to decipher which ones I believe are going to be the best of the best. And so that one will be, obviously it'll be covering a lot more stocks. I'm not going to be pulling up all those charts, mind you, but I will kind of look into my crystal ball, if you will, which is the charts, and try to figure out which ones are strong versus which ones are weak heading toward earnings. And I think this is really what we have to go on. Nobody knows for sure. But what we do know is that Wall Street is placing their bets. And the way we know where they're placing their bets is by looking at the charts, not by listening to CNBC. Always focus on the charts. So that's basically what I had. I appreciate everybody stopping by. I do want to, again, anybody that came in late, just mention we are running our webinar special, which is through Wednesday, July 14th. So you got a few days here. If you haven't already tried our service, if you want to give us a shot, we have a 30-day no-cost trial. No cost, 30 days. It's going to span a lot of really good webinars. I issue a daily market report every day. Try us out and see what you think. I think it'll help your investing and trading. I think you'll learn a lot. Again, we really focus on not just research, but education. But check out the webinar special, 13 months for the price of 12. So you're going to save on a monthly basis. You're going to save that $147. And we get this question a lot. If you are a trial member and you want to take us up on this, you get the rest of your trial period before your 13 months starts. So let's say you start a trial today, and sometime between now and Wednesday, you're like, okay, I feel pretty comfortable. I like what you do. I want the annual. You'll get the rest of your 30-day trial, and then your 13 months will be added to it. So you're not losing anything. Just want to make sure everybody understands that. But it is a big savings. We always do this because we appreciate our members and those who maybe are considering looking at us. We appreciate you taking your time out and being with us. So I want to wish everybody a great weekend. Be safe out there. We'll see how the market reacts next week. But once again, stock market moving higher, pre-earnings. I wrote about it. Check that out. That was another Chart Watchers article a few weeks ago. But these 3 weeks heading into earnings season towards the kickoff of earnings season, these are the best periods of the year historically. So what we're seeing right now is not a whole lot different than what we typically see, which is a rally into earnings. Anyway, everybody have a great day. Appreciate you tuning in, and be back on Monday for the next Trading Places live show. And like John said at the very beginning, tons of webinars coming up. So be sure to check out our events calendar. Take care, everybody. Thanks for tuning in.